Hey, it's Justin Harvey. Thanks for tuning into the Anesthesia and Pain Management Success podcast. With APM Success, we take a close look at important topics pertaining to business, practice management, personal finance, and careers for anesthesiologists and pain management physicians. We work hard to take your critical questions straight to the experts. Thanks for listening. Thanks for joining for another episode of APM Success. Thank you for your forbearance in hanging in there for an extra week, as we recently have had a child, which has been awesome. And I am way back down in the bottom of the hole of sleep deprivation. That has pushed our production schedule back a little bit, but glad to be back and excited to share today's topic, which is something that I've addressed in various ways in the past, and I frequently talk about with clients. And what I want to talk about today is what's called the financial durability ratio. And this is something that anyone can take a hold of and quantify in their own lives. Understanding your financial durability ratio will give you a sense for the extent to which a financial problem, an unforeseen expense, or catastrophe may negatively impact you, and your resistance to being negatively impacted based on your level of preparedness. And as a bit of background, there is an idea that the podcaster Tim Ferriss espouses, which he calls fear setting. And I have found this to be a really helpful exercise in financial planning, where you consider essentially, what's the worst thing that could happen to me across any of life's various facets. It could be financial, professional, personal, health-wise, whatever. And the way that this exercise goes is to essentially sit in a dark room for 15 minutes, close your eyes, and imagine that that's your life. And think about, what would I do if ... fill in the blank. And there's obvious financial application here, because this type of thinking can help you quantify potential catastrophe or problems that you may face. And as a result, prepare and build a financial plan that is more durable to resist those types of catastrophes. It's a well-known fact that there's a lot more anxiety created from an unknown set of circumstances than from a known bad situation. Known bad is better than unknown, because if you're dealing with unknown, you're often harvesting all of the problems of these bad circumstances simultaneously and living all of them emotionally. But if you have a quantified bad circumstance, you can address it with a bit more precision and emotional distance. This is something I've observed with my own clients in many cases, where the unknown drives them to work with an expert, and they are assailed by all of the things that might go wrong that they're not sure if they're prepared for. And in some cases, even if the news is bad, if the financial problems are real, they experience significant emotional relief from having the opportunity to deal with those problems and having a concrete path forward. So here's where we're going today. There are twofold considerations. The first is to consider the highest costs you're likely to incur with a personal or professional tragedy. And then the second is, how do you configure your personal financial affairs to maximally protect you against these unfortunate eventualities? So let's consider the highest cost problems that you may experience. There's a laundry list of them. And if you drive a car, there's a bunch of potential problems, financial problems that can come with that, either from damage to your vehicle, damage caused by your vehicle. If you're a physician, then there's the obvious medical malpractice, potential lawsuit. If you are a business owner or a practice owner, then there's it's not even a clinical problem. It's somebody slipped and fell in my lobby and hurt their hip, and they're coming after me for pain and suffering. There's if you're a homeowner, maybe your roof is leaking, maybe your dog bites the mailman. Any of these has a specific dollar value that you can reasonably assign. Everything from, okay, my car engine blew up and maybe that's $5,000. So in order for me to not fear that, I need to have at least $5,000 in a savings account, all the way up to I'm a practice owner and my EMR got locked up by cyber thieves and they're asking me for $3 million of Bitcoin right now. What the heck do I do? Should I pay that? Should I not? Does my insurance cover it? I'm losing money every day that my clinic isn't open. This is a big problem. So, what I would encourage you to do is just sit down and make a list of these things and then write the associated dollar value that you think each may cost. Now, one thing that you'll notice, and this is kind of an aside for today's conversation, but it's going to be a topic we'll address in the next couple of weeks. One important thing to notice is that many of these problems are almost fully addressable by a good insurance policy. And a proper risk management paradigm necessarily prominently features insurance, the right kinds of robust insurance coverage to protect you against a lot of these things. Insurance with high limits, with quality carriers, and in many cases, a broker, a personal relationship that you have with an actual human who can help you navigate a potential claim. These are things that I always recommend for any attending physician. And a quick note to residents and fellows out there, especially if you have recently transitioned to attendinghood in the last 3 months, you may still be in this mindset of, I'm only on the PGY5 pay scale and I'm trying to cut every corner possible. The reality is that robust insurance protection is one of those things that's just worth doing. And you may not have yet fully switched over your decision-making paradigm to one that accords with your very high level of income. But the reality of the fact is, if you're making $300,000, $500,000, $750,000 a year, then good insurance is going to be some of the best money that you will spend in terms of risk management dollars. And so I would strongly encourage you, if you haven't revamped your renters or homeowners or auto policies since graduating from fellowship, and if you were skating along on sort of the bare bones types of policy limits, please review that and boost them in order to make sure that you have protection in these important areas. So the first step of this process to understand your financial durability ratio is to quantify the out-of-pocket cost, or if you want to get more aggressive with it, just the total realized cost, understanding that insurance may or may not pay out depending on the policy that you have and the circumstances, and figure out what are the worst things that can happen to you financially. And then the second step in this process is to assess your assets that are going to protect you from these adverse circumstances, the assets that you have accessible to meet your needs. Insurance is a critical piece, but then we want to look at what are the other tools that you have in your toolbox to be able to keep you from going bankrupt. What I'm going to do now is sort of discuss a hierarchy, starting with the most accessible and moving to the least accessible, and identify a couple opportunities for optimization. And one of the, just to give you the bottom line here, one of the primary purposes of this exercise is to identify low cost or no cost ways to meaningfully augment your risk management and the cash that is easily accessible to you. Often this can be done with just a couple, minutes and doing a little bit of paperwork. Adding an insurance policy is a great example of, for a discrete amount of dollars, you're getting significant leverage through a high policy limit protection. But there are other opportunities. So the obvious first line of defense is, how much cash do I have on hand? Cash and cash equivalents in checking and savings accounts. I'm not going to spend too much time on this other than to point out, you want to make sure that you're aware of the interest that your cash is earning. If it's in a checking account, it's likely earning close to zero. If it's in a savings account, you want to make sure it's a high yield savings account yielding close to 5%. I will say that as of the time of this recording, which is the middle of September, the Fed just reduced rates 50 basis points as a signal that they're no longer concerned about combating inflation, or at least other goals are taking precedent. What that means is many other interest rates are going to move in lockstep, and that sort of cush 5+% high yield savings account yield that we have seen historically may be taking a little bit of a haircut. So that's something coming down the pike. So make sure that you're aware of FDIC insurance limits, meaning an account that you have on deposit at one of these institutions is covered by the Federal Depository Insurance Corp, but only up to $250,000 per account holder. So make sure that if you have balances in excess of that you are aware. So you've got your cash, that's first. The second most accessible asset is generally a taxable brokerage account. Now, this is an account that is not a retirement account. It's an account with a brokerage like Charles Schwab, Fidelity, Vanguard, one of those guys. It's invested in mutual funds or ETFs or individual stocks. It's liquid, where you can just sell everything, turn it into cash within 24 hours, move it to a checking account, and have that money accessible to you. This would be a second bucket, and one that, as your ability to save exceeds your tax advantaged capacity. Meaning, if I can save in a 401k and a Roth IRA for 23,000 and 7,000 respectively, that's 30 grand of tax advantage savings. But maybe in a given tax year, I want to save 100 grand. That probably means I'm going to throw 30 grand into tax advantage savings, and the other 70 is going into a taxable brokerage account potentially. So hopefully, attending physicians are over time building up this taxable bucket meaningfully. And that can be an important engine for net worth growth over time. After that, we get into the more uncomfortable and somewhat costly buckets to access capital. You can access 50% of your 401k balance, usually, in a loan up to $50,000. So if you've got $250,000 in a 401k, you can take a $50,000 loan from yourself, from your retirement account, and pay that back over a 5-year period and access that 50 grand for whatever purpose you want to without any credit underwriting or anything else. So that can be a pool of money. You can also access Roth IRA money to the extent of basis, meaning if I put $30,000 into Roth IRAs, it grows to $50,000 over time. I can remove that $30,000 without adverse tax consequences, assuming that I've kept good records along the way, because I may have to quantify that to the IRS. But Roth IRAs are a no penalty way to access some amount of funds. Now we're getting into the more interesting opportunities. Home equity line of credit. This is one of my favorite low or no cost additions to this paradigm that will enhance your ability to be robustly protected against these financial problems that you may experience. Home equity line of credit will get you the ability to borrow against your primary residence at some interest rate. Usually it's higher than a mortgage rate. So if your mortgage is at 6% right now, a HELOC might be at 8.5 or 9. But what you can do is borrow up to a certain percent of LTV, loan to value ratio, meaning if I've got $1 million house and I put 20% down, so I have $800,000 of a mortgage balance and 200 grand of equity, there are lenders out there who will take you up to 90% LTV, meaning I can get up to $900,000 of total debt. So a lender who's willing to do that will say, okay, you've got an $800,000 mortgage. That's the first lien. We'll give you a second lien, a revolving line of $100,000, a home equity line of credit that it doesn't cost anything to set up, except for maybe the cost of an appraisal, which could be $300 or $500. And then you'll have access to 100 grand at a moment's notice. It basically is like a checkbook. You don't incur any cost to carry it with most lenders, but you can stroke a check for 100 grand if that emergency happened. And that's a really nice thing to be able to do. If you don't have a line of credit set up and you do have equity, consider getting that HELOC configured. Another low or no cost option is to do an overhaul of your credit card setup. And what I mean is this. Number one, figure out what your total credit capacity is, because one of the things you can do is basically max out every credit card on your way to trying to fund in the event of an emergency. And if you only have one credit card and it's got a $10,000 max, and then you have financial problems, then $10,000 is the most you're going to be able to access. But if while you have solid credit, good employment, verifiable employment history, you're going to be able to considerably expand your credit capacity during this time, either through a combination of new credit cards, where you're getting a new card, maybe at another 20 or 25 grand that you can access 0% for 18 months. Just getting that new card doesn't cost you anything. You don't even need to use it or carry it. You just throw it in your desk drawer and forget it's there. But there may come a time in the next 18 months where you would benefit from having a 0% line of credit that you could access, or beyond that introductory period, maybe, you can access that 25 grand at a higher rate of interest, which you wouldn't want to do unless it was an emergency, but that's what we're talking about here, is the emergency. So getting that new credit card doesn't cost anything, expands your credit capacity, and can be helpful. There may be some credit score impact. So one thing to be aware of is if you're trying to get a car loan, you're trying to get a mortgage, you're trying to be underwritten by the bank for a practice loan or something like that. Don't just do this willy-nilly. But if things are financially stable for you, you may consider a step like this one. And then for existing lines of credit, existing credit cards you have, you can actually talk to the credit card company and say, hey, I want to revisit my credit line and take it to the max possible. And usually they'll ask you for some updated income and perhaps net worth information. And on the basis of that information, they may expand your credit line from $20,000 to $35,000 of a max credit capacity on a given credit card. What I suggest is consider going through all your credit cards and basically getting as much capacity as you can. Just as a practice, it's good to be able to have all this capacity and you don't have to use it, but it's there for a rainy day. What I would then do is go through and lock up your credit, go to each of the 3 bureaus, the major credit reporting bureaus, and lock them down so that this additional capacity that you're creating doesn't fall into the wrong hands. As we're then continuing to work down the hierarchy, we're talking about friends and family loans, unsecured personal loans, cashing out retirement accounts, your 401k, 403b, TSP, et cetera. And then we're talking about like selling personal property. Each of those are sort of progressively more painful. And what you would then do, as we're thinking about the financial durability ratio, is there's a couple ways to look at it. One is to figure out what is the total cost that I could access to meet some unexpected expense. And if you sum up cash and cash equivalents, taxable accounts, 50% of your 401k or 50,000, whichever is less, Roth IRA basis, home equity line, and then all of your credit capacity. I suggest that those are the terms the variables that should be included here. You take that on one hand, and then you would take the annual living expenses on the other. And having a multiple of your annual living expenses from all of these sources is a useful metric. And the financial durability ratio would be that ratio. Another helpful way to look at it is just what is the gross amount itself. So that if there's a one-time event that doesn't necessarily impact, your ability to earn income is used to obviously pay your living expenses. So if this event, this catastrophe, makes it so you can't work, then a multiple of living expenses is a useful way to look at it. If there is an event that doesn't impact your ability to work, but does create this big bill, then having the gross amount handy is a way that is a useful quantification. And then here's the bottom line. Through a combination of quantifying potential life circumstances that could result in a big financial impact, and then quantifying this financial durability ratio, and then going through and doing some housekeeping, doing some tweaking to optimize the numerator of this ratio or to maximize the gross amount that you can meet. This does give you a very concrete idea. It takes the anxiety associated with the unknown and it says, well, anything less than $2.3 million, I'm going to be able to deal with on short notice. And if it's more than that, then I need to probably consider bankruptcy. That's obviously a separate conversation, and one that in the event of a massive judgment or big legal problem would come into play at some point. But this is a step that you can take to be prepared in advance. So hopefully this is helpful. Next week, we're going to address a question that I've been running into with a few clients of late, which is how do I help aging parents deal with the operational and financial realities of their lives and creating a smooth intergenerational operational setup so that you can help your parents, give them the privacy and autonomy that they need, but also put some protections in place to make sure they have support at the time that they need it. So stay tuned for that one. Thanks as always for tuning in, and I'll talk to you next week. If you liked what you heard this week, head on over to apmsuccess.com, where you can find more content and free resources to help you build a successful career in anesthesia and pain management. If you wanted to leave a review in iTunes, I'd also really appreciate it. Thanks for using some of your valuable time to join me today on APM Success.